Is index investing a bubble? If you read a lot of financial media, you might think that it is. A quick Google search for index investing bubble reveals articles like passive investment blamed for inflating stock market bubble. Could index funds be worse than Marxism? And the next bubble, passive investing in ETFs. These articles all make it sound like index investing is the next big bubble waiting to burst. But there's just one problem. Broad market index funds outperform the vast majority of active managers. According to research by S&P Global, they outperform 90% of active fund managers over 10 years, 89% over 15 years. S&P's research further states that the average actively managed large cap fund cannot beat the S&P 500 over any period. The most favorable time frame for active managers is 1 year. Over that period, only 55% of active managers underperform. But as the time frame grows larger, the S&P 500's outperformance gets harder to ignore. It's clear that indexing outperforms most active strategies over long periods of time. Still, that hasn't stopped people from saying that index funds are a bubble. The most famous of these would probably be Michael Burry, who in a Bloomberg interview said, "The bubble in passive investing through ETFs and index funds, as well as the trend to very large size among asset managers, has orphaned smaller value type securities globally." Also skeptical of index funds is Peter Lynch, an active manager who achieved a 29% compound annualized return in the 1980s. In a Bloomberg radio interview, he said, "The move to passive is a mistake," and he warned that those who bought index funds would miss the boat. On the other side of this debate is Warren Buffett, who in 2008 bet a hedge fund manager that a basket of hedge funds would not be able to outperform the S&P 500. In 2015, he won the bet. Buffett has gone on to say that he's a big fan of index funds, which he says his wife's money will be invested in when he's gone. The bottom line is, there's a lot of smart people on both sides of the index fund debate. So, who's right here? There is zero doubt that, in theory, index investing can create problems for capital markets. Index fund godfather Jack Bogle once said that if everybody invested in indexes, there would be a market failure. So, what are these problems Bogle is talking about? Most of them revolve around a scenario where 100% of investors put their money into indexes. In such a situation, we would lack something called price discovery. As Seth Klarman puts it, at the extreme, if everyone practiced indexing, stock prices would never change relative to each other because nobody would be left to move them. What Seth means is that in a world where everybody is in index funds, stocks will cease trading based on business performance and will begin to trade based solely on index weighting. As a result, capital will not be allocated to its most effective use case. The scenario Klarman describes is not the situation that we're in today, but it's not hard to picture a world in which we get pretty close to it. Suppose we get to say 99% of equity investors' money in indexes. In that scenario, dynamics would emerge similar to those seen at 100%. Those dynamics would include 1. Companies not being able to go public. In a 100% index world, there's no demand for anything that doesn't already have index weighting. Therefore, IPOs get no buyers. In other words, new stocks can't list on the market. Founders have to find private buyers in order to sell stock. 2. Bankrupt companies remaining at multi-billion-dollar market caps. If price is wholly a function of historical index weighting, then it doesn't matter whether a company exists or not. Historical demand for its shares means continued future demand. 3. Obvious opportunities not being bought. Once an index gets 100% of investor money, stocks' relative weightings don't change. So you eventually get things like extraordinarily high, yet safe and well-covered dividend yields in smaller stocks on the index. In the 1980s, Warren Buffett famously bought Coca-Cola shares at a fraction of the price they trade for today. In the ensuing decades, Coca-Cola's dividend payment increased so much that Buffett is now getting a 54% yield on cost from Coca-Cola. Imagine being able to get a 54% yield on a stock, only you can buy it right now instead of waiting decades. Something like that could theoretically happen if there were no price discovery. So, where does all this lead? Points 1 and 2 that I just mentioned would eventually lead to investors going into private equity in droves, seeking better opportunities than are available on the public markets. Point 3 would eventually lead to indexing itself falling out of flavor because, again, note I'm assuming that 100% of investors' money is in indexes, the opportunities in smaller cap stocks would start getting very obvious. The third of the issues I mentioned gets to the heart of Michael Burry's critique of indexing. In the Bloomberg interview mentioned earlier, Burry noted that Korean stocks consistently traded at low earnings multiples and never seemed to rise from those cheap valuations. For example, if you look at Samsung stock today, it trades at just 7.4 times earnings, despite its American counterpart Apple going for more than 20 times earnings. Samsung stock is up all of 5.3% over 5 years, despite the fact that its business has grown in that period. It certainly looks like an undervalued situation, but nobody's buying. This could be due to index fund money not flowing into Korea. Michael Burry seems to think that that's the case. Now, you might be thinking, okay, all the money is going to index funds now, and since active managers underperform, it will always go there. Index funds are simply the place to be. Truthfully, index funds probably are the place to be for now, but as the percentage of money in index funds grows, it gets harder for the index to produce strong returns. If, hypothetically, all of the world's money were in index funds, then a given index fund could rise in price from only one of two factors. 1, growth in the money supply. 2, people moving from one index to another. As mentioned previously, there is no price discovery when the entire market is in index funds, so returns are limited to an increase in the amount of money people have to invest and the moving of funds from one index to another. But that still leaves open the question, how do you get returns from any non-index investment in such an environment? One possibility is through dividends. If a company thrives while its stock price stagnates, then its dividend yield can increase over time. Today, many investors think that investing just for the sake of dividends is unwise because of an idea called dividend irrelevance theory. Dividend irrelevance theory states that dividends are not relevant to total return, as the payment of a dividend decreases retained earnings and causes the stock price to fall. Ignoring taxes and investment opportunities, total returns should be the same whether a stock pays a dividend or not. But with no price discovery, this picture changes. If stock prices never reacted to anything except for index fund flows, then prices would not adjust to dividend payments. Therefore, it would be possible for a company to raise its dividend to the point where it has a high double-digit yield, making it possible for investors to realize high returns from dividends alone. To return to Warren Buffett's Coca-Cola investment for a minute, that's yielding 54% now. It took Buffett many decades to get his yield on cost that high, but imagine if you could buy a stock today yielding 54%, and it was well covered as indicated by a low payout ratio. That would be a good opportunity, and in a world with no price discovery, it could theoretically happen. Another possibility is moving into other asset classes. Private equity often delivers great returns because deals are negotiated individually and buyers don't face a lot of competition from other buyers. According to the CAIA Institute, private equity funds outperformed the S&P 500 by about 5% annualized from 2000 to 2021, showing that a certain category of actively managed funds is in fact doing quite well. Private equity is already outperforming today. In a world where the stock market was dominated by index funds, we would expect it to outperform even more. Having looked at all the relevant factors, can we now declare that index investing is a bubble? As of today, the answer to that question is no. According to research by the Vanguard Group, only 10% of the money in the stock market is invested in index funds. Other studies suggest a higher percentage than that, and it probably is higher if we include strategies like closet indexing, But nobody credible is suggesting that index funds are anywhere near 100% of the global equity markets. It would take a very high percentage of the world's money being invested in just index funds in order for price discovery to stop occurring. The fact is, we just aren't there yet. Nevertheless, the theoretical problems with indexing are hard to ignore. From a societal standpoint, the function of investing is to allocate capital to its most productive use. If index funds took over the market, that would cease to happen, as productive but small users of capital would not get funding in public equity markets. Most likely, private investments would rise in prominence relative to an overvalued public market. That doesn't mean you should stop investing in index funds, but it is something you might want to keep an eye on over the long term. That's it for me today. Happy saving.